Hey, good morning, everybody, and welcome to this Your Daily Five. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and it's a pleasure to be with all of you today. I've got five charts with you that I'm really watching closely. Got a lot of volatility in the market. The VIX has been picking up. A lot of trepidation in the market. Anytime you get the VIX moving higher and we get more fear into the market, you definitely have to stay on your toes. So I'm going to give you my five top charts. And I'm going to give you an article also that I had written back in November that ties into one of the charts. But let's go ahead and get started. So the first chart I want to give you today is a chart of the VIX. But I want to start with this article that I wrote on the VIX back on November 26, 2023. So this was shortly after we had bottomed in October, started moving higher. And I just mentioned the VIX because it was so low at the time, down in the 12s, that we didn't really need to worry about a lot of selling. And I broke down the VIX throughout this secular bull market advance. So basically over about the last 11 years or so, just showing you what the actual annualized return is of the VIX at various price points on the VIX. So when you have the VIX below 13, you can see the annualized return on the S&P 500 is over 47%. So that's why I really like to have a low VIX in my trading. S&P 500 annualized return drops to about 31% when the VIX is between 13 and 17. When the VIX closes between 17 and 20, we start moving into just slightly more cautious mode as that annualized return on the S&P 500 drops to just a little over 15%. But when the VIX moves through 20, I mean, if you're talking about a time when you really want to maybe think about being in cash, it's when the volatility index moves through 20. Since 2013, anytime we've had a VIX that has closed above 20, the annualized return of all of those days on the S&P 500 is a minus 36.74%. So as the VIX rises, so too do the risks of trading. Let's take a look at that VIX chart now because and I'll give you a quick update where we are. Right now, we're at 1866. We hit a high today of 1956. And you can see that really over the past year, we've only had one trip above 20 on the VIX, and that was during the correction in the summer of 2023. So if we continue moving higher on the VIX and get through that 20 level, that could open the door to much more selling on the S&P 500. Currently, I think it's fairly well contained. You know, we've dropped maybe 4% from the recent high, but much more selling could ensue if we see that VIX move through 20 and it remains above 20 for a period of time. So just keep that in mind. If you look back when the VIX was down at around 12, I mean, this was down in November when I was talking about it down in the mid 12s. We've gone from 12 to 20. And even prior to these last few weeks, we had gone from 12 up to about 16. And while we were doing that, the market kept going higher. So it's not always about the VIX rising. It's about the VIX getting to a certain point and then continuing to rise. This weakness that we finally seen occurred simultaneously with this rise in the VIX moving up near 20. Getting up into that 17 range, 18, 19. But when we go above 20, if you look at history, any rise in the VIX above 20 generally results in very steep selling. So this is a key level to watch on the VIX, no doubt. And it's probably going to be one of the first charts that I look at each morning and throughout the day until it begins to settle down. The good news is if we do top at 20, or maybe even just above 20, when the VIX tops and begins to roll over, that usually coincides with a very nice rally in the S&P 500. So the VIX and the S&P, we need to keep an eye on both. The next chart I'm watching is the IWM, the Russell 2000. I loved the breakout on the IWM above this triple top. We saw that back at the end of 2023. Since then, we saw the PPO go positive. Every pullback that we've had on the IWM has traded above the 20-week moving average. But notice what I've circled this week. This is a weekly chart. Currently, if we finished where we are now, let me get a quick update, see where we are. If we finished where we are right now, we would have a breakdown come Friday on this 20-week moving average. When you see weakness in the market, and in particular this IWM chart, when you start to strengthen, you'll see that PPO turn positive. You'll see highs, higher lows, and then new highs. And so when you see that, that PPO turns positive. And then when you pull back, what you're looking for is support at that rising 20-week EMA. Check this hammer out that printed back in September of 2020. Intra-week, it would have looked very similar to what we're looking at right now. And currently it's Tuesday. So we got another few days to get to the end of the week. The big question is, do we have this breakdown on the 20-week moving average by Friday's close? Or do we see something very similar to what we saw back in September, where it looked like we were rolling over, and then by the end of the week, printed a hammer, held on to the key support level, the moving averages, and then look what happened afterwards. So these false breakdowns to the downside can be extremely bullish, but the real breakdowns, like we saw back at the end of 2021, those you can see what it led to a lot more selling. So the first step, short term, is are we breaking down or not? And this is a weekly chart, so Friday gives us the clue. Maybe we have a big reversal, maybe we see the selling accelerate, but with the VIX near 20, the IWM potentially breaking down, these are some, rather precarious times in the market. We'll see what happens into the end of the week, but keep an eye on the IWM. Next up, this is a really interesting chart on the 10-year Treasury yield, because after we topped at 5% and we fell, notice the timing of this huge drop in the 10-year Treasury yield. Late October through late December. What happened? We had a massive rally in equities. After the yield dropped and started turning back to the upside, we started seeing more and more rotation into financials and industrials and away from areas like technology, consumer discretionary, and communication services. So on this move up, the character of the market changed a little bit, and that it was a little bit more value oriented. Then we saw the yields fall after rising from 378 back up to 435. We fell into a cup, which went all the way down to about 404 from a 435 high. That's 31 basis points. Came all the way back up those 31 basis points right to 435 before putting in a handle. And what has happened in April? We've broken out of the handle, broken above the top of the cup, and that measurement, top of the cup to the bottom, 31 basis points, tack that on to 435, and what's your measurement? 466. Where are we trading? Let me give you an update right now, 464.9, 465. But today's high was 470. And notice that is the start of this gap resistance area. So we've got key overhead resistance from probably about 470 to 480. And now to the downside, what we want to see if you're bullish is a move back down below 465 and moving back down toward where that cup broke out. Will we see it? I don't know. My guess is as good as yours. Yours is as good as mine. But we'll both watch it together and see. That looks like right now it could be a reversing candle today, but we still got another few hours, 4 hours, a little under 4 hours before the bond market closes. We don't know what this candle is going to look like by 3 o'clock Eastern this afternoon. So we need to watch it. But if it finishes higher, closes on the high, you're probably going to see a continuing sell-off in the market, and you'll probably see that VIX break above 20. If that was the top of the 10-year Treasury yield and we start moving down, then we should expect equities to rise back up and the VIX perhaps to top at 20, 19 and change. So I think we're at a really precarious area right now in the market. Not really sure which way we're going to go. I wish I had that crystal ball. I can tell you that my long-term signals remain bullish. So I don't expect that this is going to be a massive, 6 to 9 month cyclical bear market or anything like that. I don't even think we're going to have a correction, although if we break down today and we finish weak, the odds obviously begin to increase of a potential correction. But I said in March, and right now I'm going to stick with it, that I thought we were going to see about a 4 or 5% pullback. We never saw it in March. Maybe it's just getting here a little bit late. I don't know. But that reversal here would mean a lot. Let me show you the bottom part of this chart. And this is the correlation between the Treasury yield, the 10-year Treasury yield, and the direction of the IWM, which is the ETF that tracks the small cap Russell 2000. And if you look down below here, you're going to see that the relationship or the correlation has been an inverse one. In other words, when yields go up, IWM goes down. When yields go down, IWM goes up. I don't know a better way to illustrate this for you than to show you this correlation where we have been mostly between minus 0.5 and minus 1.0, which is very, very strong inverse correlation. And so why has the IWM been the weakest of all of late? Look at what yields are doing. Yields are going up. As a result, that inverse correlation has been sending the small caps down. And I've talked about this in the past. It's a show in itself, so I'm not going to get into why. But I believe in time, rates will come back down. The IWM will outperform. Right now, it's the opposite that's taking place. This needs to change. So is this a reversing candle on the 10-year Treasury yield? If it is, then you are likely to see the IWM bottom and perhaps put that hammer in on that 20-week moving average. So it's not all about just looking at the major indices and looking at their charts. It's also about these intermarket relationships that you need to be aware of. All right, I got two more charts for you. First, Apple. What's been going on with Apple? This is the last year. And what I did is I did a volume by price overlay so that you can see between 168.5 and about 177.5. This is where most of the volume has been on the Apple chart over the last year. So that just tells you that this is an area of indecision. It's an area of which way are we going? And look at the most recent 2 months or month and a half on Apple. Isn't that exactly what it's telling us right now? Where are we going? We're sideways consolidating. Are we going to break down? Let's get an update here, see if we got anything. No, we're still just kind of hovering near the lower end. 2 days ago, could not get through the upper end. Which way are we going? You might also take a look at that low in October because that's just slightly below down in that 165 area. Maybe we get a false breakdown and then make a rally back. But clearly this area that it's in has been a very influential area in that if you're below it, trying to get back through it's difficult. If you're above it, trying to break down beneath it has been difficult. It's just an area where we have seen a lot of reversals. So Apple, I think, does it break down? Does it hold and move back up and eventually break out? That will go a long way to determining what happens with the S&P 500 and the NASDAQ, because Apple, along with Microsoft, are the two largest components. Both of those indices are market cap weighted, and Apple and Microsoft are your two largest companies. So their market caps matter in those two indices. So Apple, watch this chart. Which way do we break? So let's take a look at the QQQ as our final chart. Listen, I'm going to be objective. We broke down yesterday on the QQQ. Let's see if we got any kind of an update here. Trying to rally back a little bit, but that was a breakdown on the QQQ. This short-term support area, and I'd been telling members to watch about 432, 433, because on each one of these pullbacks in the last 2 months, we were holding that level, 432, 433, every time. And then yesterday, we failed to hold it. Closed down at, I think we were down around 431, a little bit above 431. Today, we're up right now about 0.2% on the QQQ, but that breakdown is clear. And when I see a breakdown like that and the PPO turning negative, that tells me one of two things. Either we are in a trendless environment where we are going to go down and find one of these areas of support and just trade in a range for a while, or we're downtrending. And the next sign to me that would be that, hey, we might be downtrending, would be any kind of a failure, a rally and failure at the 20-day moving average, and then rolling over and setting a new low again. So in a trending environment, the 20-day moving average acts as support in an uptrend and resistance in a downtrend. If we just start going up, above it, below it, above it, below it, that tells us it's trendless. So I'm not thinking anymore right now about an uptrending market until we actually can get up and take out 450. Until then, we're sideways consolidating. I mean, you can take a chance if you go through the 20-day moving average that that's going to hold from that point forward and that we're going to break out. But we don't get confirmation that another uptrend is in play until we get that breakout over 450. And we're sitting at 430. So it's going to make trading a lot more volatile. It's probably, you're going to see a lot of knee-jerk reactions in both directions. And that also occurs anytime you get a VIX up near 20 or definitely above 20. So let's watch the QQQ. Same thing, same goes for the SPY, the S&P 500. But do we go down and set, another low at a recent, here was gap support. Here was a breakout of the December high. Here was a breakout of that late November high. Do we go down to these levels? I don't know. Right now, though, you have to respect this short-term breakdown in the QQQ. And then again, can we get back up and get back above those moving averages? That would be a good sign to me. Not that necessarily we're rising, but that we are consolidating as opposed to downtrending. And once you start getting the feeling of sideways action, you can start to plan your trades. You can start looking for the stocks you like, blah, blah, blah. When you're in a downtrend, you really just kind of want to sit back and watch. All right, if you like the way we approach the market at Earnings Beats, head over to earningsbeats.com. You can sign up for a free 30-day no-cost trial, or if you want to go down below on our homepage, you'll see we have a free newsletter. Name and email address, all it takes, no credit card required. This comes out 3 times a week, Monday, Wednesday, Friday. I like to share a lot of the things that are important to us. So I'll talk a little bit about seasonality. I'll talk about moving averages. I'll talk about relative strength. I'll talk about price volume, candlesticks, those types of things that are really important, divergences, and so on. Anyway, it's a very quick read. Usually it's 1 chart and 2 paragraphs 3 times a week. That's a pretty easy newsletter to read through, but I think it'll provide you a lot of education, maybe something that'll help in your trading. So definitely check that out. It's been a pleasure again joining you on your Daily 5. Be sure to check us out over at Earnings Beats, but really keep an eye on these 5 charts I've shown you today, and the VIX particularly. If we stay below 20, I think we're okay. We get through 20, it's a whole different ball game. Have a great day, everybody. Happy trading.